Chapter 3. Many Ways to Assess Value. The most striking aspect of the present state of ratio analysis is the absence of an explicit theoretical structure. The user of ratios is required to rely upon the authority of an author's experience. As a result, the subject of ratio analysis is replete with untested assertions about which ratios should be used and what their proper levels should be. James Horrigan. Since the late 19th century, the growing availability of financial statements has raised the issue of how best to analyse the information they contain. People have taken an old idea from the ancient Greeks about ratios and used this to focus on the relationship between different items in a firm's financial statements. They use these relationships, or ratios, to predict whether a firm might be likely to fail in the future, or perhaps more positively, what its earnings or other performance measures might be in the future. The only problem with this was there was no clear reason why these ratios should be useful to predict future outcomes of firms, and no clear evidence that they indeed were useful. There was no theory, no mental framework or connection, no understanding for us to think that these ways of analysing a firm's financial statements help us meaningfully engage with the future economic and business realities of firms. There have been some attempts to provide a framework or structure for certain approaches to analysing financial statements, but it is still not clear whether these approaches are of use to us in predicting future economic and business outcomes of firms. With the growing availability of computers and electronic databases over the past 50 years or so, attempts have been made to identify relationships between aspects of a firm's financial statements in the past and subsequent measures of its performance. Except possibly for predicting corporate failure, this research has been largely unable to identify stable relationships between aspects of firms' financial statements and their future economic and business realities. With the lack of any convincing theory to support specific approaches to the analysis of financial statements, many ways are used in practice to assess value in our capital markets today. We will look at the use of comparables, and especially the use of PE, price to earnings, multiples. There are many other ways, including a range of other purportedly fundamental valuation techniques and various technical analysis methods, based on looking at patterns of past share prices, which we will not discuss. Many of these methods do not have a clear theoretical connection to the present and future economic and business realities of firms. They can often be based on speculation, seeking to outguess other participants in the capital markets who are seeking to outguess what we are seeking to outguess about them, and so forth. Those using these range of methods can lack a clear framework in their own mind to guide the use of these techniques to ensure there is a firm connection between the results of their analysis of a firm's financial statements and the firm's economic and business realities. I will suggest that using methods and approaches to the analysis of financial statements which have a strong theoretical connection with the economic and business realities of firms can give us an edge over those analysts who primarily use methods and approaches that do not. We will look at approaches using forecasts of dividends, cash flows, and earnings as ways to help us use a firm's financial statements to engage meaningfully with its economic and business realities. I will argue that having a sound conceptual framework to analyse firms' financial statements will help us gain real insights into the value of firms, to know what adds value. 3.1. How practice developed. Euclid taught me that without assumptions there is no proof. Therefore, in any argument, examine the assumptions. E.T. Bell. With the growing availability of financial statements since the late 1800s, analysis of financial statements has become a substantial activity within the world's capital markets and within business more generally. Yet this widespread practice of financial statement analysis often does not appear to be based on a well-considered and compelling theory of financial statement analysis. To help us understand how this could be the case, in this section we look at the growing availability of financial statements and the approaches people have developed to analyse them. Availability of financial statements. In the late 1800s, as financial statements were starting to be provided more frequently to parties outside firms, they began to be more systematically analysed and assessed, particularly using ratios as a key part of this analysis. Ratios are an idea taken from the Greeks. They help us focus on the relationship between different items in a firm's financial statements. The term ratio, the Greek word for ratio is logos, was first introduced by Euclid in the Elements. Euclid's Elements is the world's second most widely translated and circulated book, second only to the Bible. Written in about 300 BC, it has had over 1,000 editions and is an astounding treatment of geometry and number theory. It brings together the concepts and theorems of Greek mathematics. It is not easy to read. It contains no examples to illustrate the concepts, no clever comments, indeed not even an introduction. It contains nothing but theorems and their proofs. Nevertheless, it is without doubt the best mathematics text ever written. Book 5 of the Elements provides a thorough analysis of the properties of ratios. The earliest use of the word ratio in the Oxford English Dictionary is from Barrow's 1660 translation of Euclid's Elements. Ratio or rate is the mutual habitude or respect of two magnitudes of the same kind to each other, according to quantity. In Heath's 1908 translation of Euclid's Elements, a ratio is a sort of relation in respect of size between two magnitudes of the same kind. I quite like the idea of mutual habitude, which sounds a bit like two people living or flatting together and focuses us on the idea of looking at the relation between two numbers or quantities. A lot of financial statement analysis uses this mathematical idea of the Greeks to help us gain insights into the realities of firms. Firms have kept accounts to record their activities for a long time. Luca Pacioli, 1445 to 1517, pronounced Poccioli, an Italian mathematician and Franciscan monk, published the Summa di Arithmetica Geometrica Proportioni e Proporzionalità in 1494. It was a summary of the mathematical knowledge of the time, which we see today as quite elementary arithmetic, geometry and algebra, and included bookkeeping as one of the 5 topics covered. Its section on bookkeeping is the first published book describing double entry accounting, a method of accounting that was being used by merchants in Venice during the Italian Renaissance. His system included most of the accounting cycle as we know it today. Although Luca Pacioli is usually referred to as the father of accounting, he did not invent the system of double entry bookkeeping. He was simply the first to describe it in a published book. A summary of the accounts of a firm was often produced and included as part of the accounts. Such financial statements were produced much earlier than Luca Pacioli's time in the late 15th century. For example, the partners Francesco di Marco de Prata and Domenica di Cambio drew up a detailed statement of assets and liabilities on August 30th, 1389, quite in the modern manner. However, it was not until the late 19th century that financial statements were more commonly developed as separate documents to the internal accounts of the firm to be provided to external parties. This may have been partly due to the emergence at that time of professional managers separate to the source of equity capital. That is, the same person increasingly did not supply the equity capital and run the business. However, the key driving force for the increasing role and importance of financial statements was the rise in significance of the banking sector in the US. This group, unlike often the equity investors, had the power to demand financial information from firms, which they increasingly did. In the 1930s, there was a further significant increase in the availability of financial statement information in the US with the enactment of the Securities Act of 1933 and the establishment in 1934 of the Securities and Exchange Commission, SEC. This legislation forced many US firms to supply financial statements, particularly to equity investors, who, unlike the banks, often did not have sufficient power to demand financial statements from firms. Nevertheless, not all firms provided their equity investors with a great deal of information. For example, as Benjamin Graham and David Dodd noted, an amusing example is Dun & Bradstreet Corporation. This purveyor of financial information does not, in 1940, reveal its own earnings to its stockholders. This increase in the availability of financial statement information brought increased opportunities to carry out financial statement analysis on firms. Increasingly, people were faced with the issue of how best to do this, how to make sense of a firm's financial statements and to use this information to help make decisions. In the absence of any theory, people developed ad hoc, pragmatic approaches to the task of analysing firms' financial statements. In other words, they just got on with it. Just do what works. In the 1890s, it started to become more common practice for bankers to request financial statements to assess applications for credit in the US. Probably, most bankers requested a balance sheet, looked over it carefully and filed it, with no attempt to apply any more formalised quantitative processes to analysing its contents. However, some bankers started to increase the level of sophistication of their analysis by adopting some quantitative assessment of the financial statements being produced by firms. This included the separation of current and non-current assets and liabilities in the balance sheet and the calculation of ratios that looked at the relationship between various line items in the financial statements. Indeed, from about the late 1890s, bankers started to pay attention to the current ratio, which is the relationship between current assets and current liabilities of a business. Financial statement analysis also started to become more popular for equity investors, although how they went about doing this was usually quite unformulated and unclear. In the first 20 years of the 20th century, an increasing number of ratios were being calculated and used to help assess businesses. Criteria to assess what were good or bad ratios began to be developed, including the then well-known requirement of a 2-to-1 current ratio. Further, the benefit of comparing a firm's ratios with the ratios of other firms was starting to become apparent. However, financial statement analysis was still largely casual and ad hoc, with only some calculating and using ratios as part of their analysis. In 1919, Alexander Wall, in his classic Study of Credit Barometrics, produced 7 ratios for 981 firms in the US. His study was influential and showed how financial statements could be analysed by calculating several different ratios for a firm and then assessing the firm by comparing these ratios with the ratios of other firms. Influenced by Wall's study, there was a rapid growth in the 1920s in the US in the number and type of ratios that analysts began to consider when assessing businesses. Ratios were also collected for industries and average ratios calculated for comparison purposes. In the 1930s, Roy Fulk successfully promoted a group of ratios as being the most useful, mostly because he was also able to supply industry data for these ratios. In 1933, while working for Dun & Bradstreet, Fulk published his ratios, and they quickly became a well-known and widely used series of industry average ratios in the US at that time. Indeed, Fulk is a significant person in the development of the practice of financial statement analysis in the US and then elsewhere. With the growing dominance of the US economy, over time the emerging practices in the US greatly influenced practice in financial statement analysis in other parts of the world, including Australia and New Zealand. Today, in the 21st century, analysts of financial statements still may often select the ratios and information they use and the criteria they use to judge this information based on a pragmatic view of what works, drawing on the authority of experienced investors and lenders. Typically, there may not be a clear framework, a conceptual map or an idea in the analyst's mind that clearly links information from the financial statements to the economic and business realities of firms. There is quite a lot of consensus amongst practitioners and others about the usefulness of financial statement analysis to examine high-level categories of profitability, long-term solvency, and short-term solvency. Profitability, how much a firm earns, and liquidity or solvency, how readily a firm can come up with cash if needed, are commonly thought of as useful aspects to examine of a firm's financial statements. However, once we seek to identify specific ratios and information from financial statements that are useful, we find a diversity of views rather than consensus. These views can be seen expressed in a range of popular textbooks and other academic writings on financial statement analysis over the years. I do not find the approach to financial statement analysis of relying on what practitioners do to be so useful, since other than agreement on the value of looking at profitability and long-term and short-term solvency in a general sense, there is surprisingly little consensus on the details. There is also no clear reason why these various ratios should be useful to predict future economic and business outcomes of firms, and indeed no clear evidence that they are. However, we can gain a lot of practical wisdom and good sense from experienced practitioners, particularly if they combine their experience with the ability to explain and communicate their insights well. In this respect, I would commend the classic work Security Analysis by Benjamin Graham and David Dodd. I would also commend the various writings of one of Benjamin Graham's most famous students, Warren Buffett. Many of us around the world enjoy reading Warren Buffett's annual musings based on his practical experience and sound good sense in his annual Chairman's Letter to the shareholders of Berkshire Hathaway Inc. These usually come out in late February or early March each year. Indeed, when the time comes for Warren Buffett to stop writing these annual letters, many of us will miss his valuable injection of views based on extensive practical experience and good thinking. It is the ability of Benjamin Graham and David Dodd and of Warren Buffett to use the careful analysis of financial statements and other sources of information to gain insights into the economic and business realities of firms that is the key to the success of their ideas. This ad hoc, pragmatic approach says just do what works. It uses a subjective classification and assessment of ratios from financial statements based on the practical experience or simply views of various people with credibility who propose them. Some people have questioned the value of doing this. They have attempted to identify a framework or structure to the analysis of financial statements to provide a rationale for analysing financial statements in a certain way. Use a structure. There have been some attempts to provide a framework or structure to support the practice of financial statement analysis and the usefulness of certain ratios. This approach to financial statement analysis is not ostensibly based on practical experience, on what simply seems to work in practice, but is an attempt to link together what we look at in analysing firms' financial statements with a logical, interconnected structure. In about 1990, the DuPont company in the US applied the idea of analysing profit margins and turnovers to a major manufacturing enterprise. This idea had been used for some time in retail businesses. The DuPont company evaluated its operating performance by focusing on return on assets, which is the relationship of profit to total assets. This was decomposed into profit margin, profit to sales, and turnover, sales to total assets. However, the DuPont company's framework for the use of ratios to analyse a firm's financial statements had little immediate influence outside the DuPont company itself, although, as we will see later, it did belatedly catch on. There were other attempts to come up with different structures. For example, in 1923, James Bliss attempted to provide a framework for the integrated use of the growing number of ratios he was using. However, his ideas generally were not taken up in practice. In the 1950s, there were a number of studies that looked at the usefulness of the DuPont approach of breaking down return on assets into profit margin and turnover ratios to assist decisions by business managers. This held some promise of being able to use measures of return on assets as a means of integrating several ratios into a coherent system of analysing a firm's performance. Since the 1950s, the DuPont approach started to gain a degree of popularity. We'll see later that we will draw on aspects of the now well-known DuPont approach to classifying financial statement ratios when using the discounted cash flow and economic profit approaches to financial statement analysis. Whether we just do what credible people say works or use a logical structure, this still begs the question: is there any reason to think that a firm's financial statements can help us predict the future performance of a firm? There have been several attempts to determine which of the wide range of ratios that could be calculated from financial statements might be the most useful, and so be what we should focus on when analysing a firm's financial statements. 3.2. Theory and practice not connected. Before going back to college, I knew I didn't want to be an intellectual, spending my life in books and libraries without knowing what the hell is going on in the streets. Theory without practice is just as incomplete as practice without theory. The two have to go together. Asata Shakur. In theory and practice are the same. In practice, they are not. Albert Einstein. With the growing use of various techniques to analyse financial statements, including the use of various ratios, people started to ask themselves some questions, such as, how useful are these various approaches? Which one should we use? Where should we focus our efforts? And is it worth the effort to use these techniques at all? These questions really came down to asking whether there was any relationship between aspects of a firm's financial statements, such as various ratios, and a firm's future financial performance and its value. This section looks at various attempts to find some answers to these questions, to find some reasons or theory why we should analyse financial statements in certain ways, or indeed at all, and why we should focus on specific aspects of a firm's financial statements. Asking the wrong questions. Since the 1930s, there have been attempts to assess the usefulness of different ratios to predict future business outcomes, and in particular, financial difficulties. This reflected the early emphasis on the use of financial statement analysis by credit providers. People did this by calculating some ratios for a range of firms for several years in the past, to see if the ratios were in some way related to whether those firms subsequently failed. Although these studies were initially fairly crude in their approach, they represented an attempt to provide evidence to support using certain ratios based on financial statements to predict what might happen to businesses in the future. With the availability of computers, much more sophisticated quantitative approaches have been able to be used to find if there are any stable relationships between aspects of firms' financial statements, usually expressed as ratios or as the relationship between two or more items in a firm's financial statements, and the future financial performance of firms. If such stable relationships could be found to exist, they could then perhaps support a useful theory that could guide what we should focus on and analyse in firms' financial statements. In 1968, William Beaver conducted an influential study on the ability of certain ratios to predict failure of firms, using more thorough and convincing statistical techniques to help establish the existence of likely relationships. Over the past 50 years or so, various academic research has adopted increasingly sophisticated statistical techniques to identify what ratios from firms' financial statements are most useful in making various decisions, in particular those relating to decisions made by equity and debt investors in firms. Except for predicting corporate failure, this research has been largely unable to identify key stable relationships between aspects of the financial statements and the future financial performance of firms. This has been despite research using increasingly impressive statistical methods to analyse extensive data from various electronic data sources. In my view, this should not surprise us. The economic and business realities of firms are complex, and the financial statements provided by firms, while valuable guides to assessing this reality, are not the reality themselves. Catastrophic events such as corporate failure may be more readily predictable from a firm's financial statements, as it often takes a few years for a firm to be overtaken by the process of corporate failure, and the signs of this can perhaps be more readily captured in the financial statements in advance. Also, banks or other providers of debt to a firm play a key role in the actual process of a firm failing. They do this through triggering processes such as threatening to or actually demanding repayment of debt by a firm when it is in breach of its legal obligations with its debt providers, or in other words, in breach of its banking covenants. Generally, required levels of key ratios such as interest cover, number of times earnings before interest exceeded a firm's interest expense, or debt to equity are incorporated into loan documentation between a bank and a firm. Should a firm's ratios at some time reach the required levels of these ratios, then the bank or debt provider would often have the legal right to demand repayment of its debt. Since aspects of the financial statements themselves can play a part in initiating the processes that contribute to corporate failure occurring, it is perhaps less surprising that aspects of the financial statements themselves might be strongly related to future corporate failure. We are focusing on the analysis of financial statements by equity investors. While prediction of corporate failure is clearly relevant to equity investors, it is a primary focus for providers of debt to a firm. By way of contrast, the primary focus for equity investors is to evaluate the potential upside. This is why equity investors invest in firms after all, since the profits, after prior claims to other stakeholders are met, go to them and not to anyone else. Many decades of searching for statistical relationships between aspects of the financial statements and future economic and business realities of firms has been unable to identify stable relationships other than possibly for corporate failure. In many ways, the wrong questions were being asked. Rather than focusing on what, if any, stable relationships there are between aspects of a firm's financial statements and its financial performance at different points in time, we need to focus on something else. Perhaps in our analysis of a firm's financial statements, we should focus on understanding how a firm's financial statements relate to the key drivers of the economic and business realities of a firm. If we could understand these relationships for a firm, And if we could make reasonable predictions of the future drivers of the economic and business realities of a firm, using a range of both quantitative and qualitative information from a wide range of sources, then we might be better able to predict for a firm its future financial performance, or in other words, aspects of its future financial statements. Indeed, financial statement analysis should not simply involve focusing on or analysing a firm's financial statements. It should involve us using a firm's financial statements to help us engage with key aspects of a firm's economic and business realities. I will say that again, just in case you missed it. Financial statement analysis should involve us using a firm's financial statements to help us engage with key aspects of a firm's economic and business realities. This involves us using a firm's financial statements to help us identify these realities and to then quantify the dollar effects they may have on the value of a firm. A firm's realities are messy and qualitative in nature. For example, key aspects of the economic and business realities of Ryman Healthcare might include the level of residential house prices in New Zealand and Australia, and the proportion of the population over 75 years that wish to live in retirement villages. We might be able to find various statistics or numbers on these two aspects of Ryman Healthcare's economic and business realities, and make some predictions about them. But how do we connect these insights into value for the equity investors in Ryman Healthcare? This is where financial statement analysis comes in. An analysis of a firm's financial statements can help us gain an understanding of the quantified dollar effects of our forecasts of Ryman Healthcare's economic and business realities. If we understand the connections between the key drivers of Ryman Healthcare's economic and business realities and the key drivers of its financial statements. What we need is a theory of financial statement analysis that will help us do this, help us to connect a firm's financial statements with its realities and to its value. Indeed, the focus of financial statement analysis should be on understanding the connections and relationships between key elements of the financial statements and the key drivers of the economic and business realities of a firm, both in the past and in the future. This in turn leads us to focus on understanding and predicting the economic and business drivers of a firm, which is at the heart of financial statement analysis. Connect to current reality. The question then becomes, what analysis of financial statements will help us engage with the economic and business realities of a firm? Financial statement analysis is where accounting and finance meet. And more importantly, it is where ideas in accounting and finance both meet reality. Financial statement analysis is the practical application or use of accounting and finance ideas. This is the exciting activity awaiting us in our unit as we analyse the financial statements of our firms. This will help us review and integrate what we know about accounting and finance as we explore how to assess the value of our firm for ourselves. We do not seek to use ratios, that is, elements of the financial statements, to predict the future economic and business realities of firms, the so-called predictive power of ratios. Rather, we will seek to connect our analysis of financial statements using ratios in a framework to the existing economic and business realities of a firm, or in other words, to be able to connect to the existing economic and business drivers of these ratios. The predictive power that we need then comes not from the financial statements. They are merely passengers on the journey of our firm. Rather, the predictive power we need comes from our ability to do two things well. Forecast the economic and business drivers of a business, which involves being able to identify how these drivers might change in the future. And connect our forecasts to a firm's future financial statements and ratios and to a quantified dollar value of the firm today. In this way, we can participate in the capital markets in an intelligent, informed, and capable way. We may even be able to make money in the capital markets by being able to make these judgments on allocating capital better than many others and avoid common mistakes of other investors. Predicting the future is an inherently uncertain activity. Who really knows what we will be doing next weekend, let alone being able to predict all the various factors and activities of a business as well as its market and economic context for several years into the future. An ordered, structured and logical approach can help us organise the information we have about a firm coherently. This can assist to focus our minds and effort on forecasting the key economic and business drivers, not the accounting drivers, and then being able to incorporate these forecasted drivers into numbers, that is, into forecasts of the accounting passengers. This will allow us to come up with quantitative forecasts of earnings and then with our current view of value. There are many ways to assess value. Some are more convincing and rigorous than others, and so more persuasive. But even within the approach to financial statement analysis that we will be focusing on, there can be as many views of value as there are people doing the analysis. This is because predicting the future requires judgments and a realization that any prediction will be wrong. So at best, we can form a view of value of a firm within a fairly wide range of possible values. The use of financial statements to help determine a view of this value is simply no more precise than that. It certainly does not lend itself to the mindless pursuit of a magic formula. However, the conceptual frameworks provided in this study guide can help us form much more robust and useful views of the value of firms than we otherwise could without them. We will be using two approaches to financial statement analysis. We'll focus on our forecast of free cash flow, the DCF approach, and on the book values for equity in the financial statements, plus added value related to our forecast of abnormal earnings or abnormal operating income, the economic profit approach. However, these approaches to valuation and financial statement analysis are by no means the only ones used in practice. In the next section, we will consider a perhaps more commonly used approach of focusing on comparables, that is, on the relationship between typically a firm's earnings or cash flows and listed share prices for comparable firms.